A house in America is no longer a home. It is a wager, a gamble, a bet on the future. What once offered shelter now comes with chains of debt, invisible but unyielding. In countless suburbs, cities, and towns, Americans wake to the quiet terror of payments they cannot sustain, prices that defy logic, and a market that has stopped functioning as it should. For decades, the mantra was simple: real estate always goes up. Buy, hold, and watch your wealth grow. But today, reality is exposing the illusion. Homes sit unsold despite high prices. Buyers hesitate, trapped by skyrocketing interest rates. Sellers cling to overvalued equity. Builders freeze projects mid-construction. And millions of Americans remain imprisoned in homes they cannot afford to leave. This is not the sudden collapse of 2008. It is a creeping, pervasive fracture, a slow-motion implosion, and it is happening right now. After the financial catastrophe of 2008, America's approach to housing was not reform, it was repair. Banks were rescued, not held accountable. Interest rates were crushed to historic lows. Money became almost free. Mortgage debt, previously a careful calculation of risk, became an easy tool. For a decade, borrowing was painless. A $400,000 home could be carried with a manageable monthly payment, barely noticed by families who would have balked at the principal years earlier. Risk did not vanish. It was merely deferred, hiding behind a veil of low-interest loans and government guarantees. During this period, the public perception shifted. Housing was no longer evaluated by the total cost of ownership but by monthly affordability. Buyers stopped asking, "Can I afford this home?" They asked, "Can I afford the payment?" This subtle change reshaped the market. Prices climbed, not because homes were intrinsically more valuable, but because debt was cheaper and more people could afford larger loans. By the late 2010s, housing had become both a necessity and a speculative product. For some, a home was shelter. For others, it was an investment vehicle, a balance sheet asset, a lever for wealth accumulation. This dual identity created a fragile equilibrium. Prices were high but not tied to fundamental affordability. Then came 2020, and the world changed overnight. COVID-19 was a sudden, global shock. Fear shuttered businesses. Governments moved rapidly, releasing trillions of dollars to stabilize the economy. Interest rates were slashed to near zero. Mortgage forbearance programs paused payments. Direct stimulus checks filled bank accounts. Student loans were suspended. The American housing market didn't just stabilize, it ignited. People fled dense urban centers for suburban comfort. Remote work turned bedrooms into offices. Investors sensed opportunity in single-family homes and short-term rentals. Real estate became a frontier for Wall Street as much as Main Street. Homes began selling in days, often without inspections or proper appraisals. Asking prices were ignored, waived, or eclipsed by higher offers. Homes became less about their physical structure and more about future price expectation. Speculation, quiet for years, now dominated the market narrative. This unprecedented surge inflated prices to levels disconnected from wages, borrowing capacity, or real economic growth. A $500,000 home was no longer expensive because it had intrinsic value. It was expensive because the market believed it would be worth more tomorrow. Speculative bubbles, by nature, are vulnerable, and when the conditions that fueled them shift, the consequences are rarely gradual. Inflation arrived subtly at first. The grocery bill rose, gas prices climbed, rent increased incrementally. The Federal Reserve, tasked with controlling inflation, acted by raising interest rates. Rising rates did not create an immediate collapse, but they froze the market. A mortgage that once carried a 3% interest rate doubled or tripled for new buyers. Monthly payments surged, affordability plummeted, and potential buyers retreated. Homes did not lose value overnight. Instead, sales halted. Inventory stagnated. Sellers refused to drop prices, holding onto inflated equity. Buyers could not stretch to new monthly payments. The consequences of this stagnation are profound. Markets do not break when prices simply fall, they break when transactions stop. The flow of real estate, the essential movement that allows people to buy, sell, and upgrade, has slowed to a crawl. Millions of homeowners are trapped in low-rate mortgages they cannot replicate. Millions of buyers are priced out. Builders, facing rising costs and uncertain demand, slow or halt new construction. The system is frozen, teetering on the edge. Beyond the obvious metrics of price and inventory, deeper structural issues threaten stability. The lock-in trap. Homeowners with mortgages at historically low rates cannot sell without dramatically increasing their payments. Inventory remains artificially low, pushing prices higher while creating unsustainable tension. Investor fragility. Small-scale landlords purchased properties at peak prices, often using variable-rate loans. Rising expenses and stagnant rent increase create a cash flow problem. Unlike 2008's subprime collapse, this is a slow bleed rather than an explosion. The rent pressure cooker. Rents were expected to absorb shocks, but stagnant wages mean tenants are maxed out. Rising delinquencies signal broader economic stress. Landlords cannot raise rents indefinitely, tenants cannot pay more. Construction bottlenecks. Builders face increased financing costs, labor shortages, and uncertainty in demand. The new supply of housing slows even as existing homes remain unaffordable. The result is a system at odds with itself. Demand exists but cannot materialize in transactions. Supply is insufficient but inflated in value, and both buyers and sellers are trapped. Unlike 2008, when the collapse stemmed from credit quality failures, today's crisis stems from affordability breakdown. People bought homes at record prices using cheap debt. That debt no longer exists. The market will not experience a single dramatic crash but a prolonged freeze with regional variation. Expected consequences. Quiet defaults. Forced investor sales. Regional declines in home values. Long-term stagnation. Social and political pressure. Rising rent unrest. Demographic shifts in housing demand. Housing, once a wealth generator, has become a weight dragging on the broader economy. The illusion that homes are safe assets is ending. America is entering a period where real estate will test patience, liquidity, and policy simultaneously. The myth of perpetual housing growth has collapsed, not with noise, but with quiet inevitability. The U.S. housing market didn't collapse overnight. It didn't topple like a house of cards in a single gust. Instead, it has fractured quietly in subtle, often invisible ways. And yet, for those who watch closely, the warning signs are everywhere. In every corner of the country, the same patterns emerge. Homes sit unsold for months. Buyers hesitate, unsure if they can commit to payments that have risen by thousands of dollars per year. Builders cancel or delay projects, even as construction costs soar. Investors are caught in a tightening vice. Debt payments increase while rental income stagnates. And millions of Americans, holding mortgages they once believed were affordable, now find themselves trapped in a financial straitjacket. This is the story of a market breaking in slow motion. A system once thought invincible now showing the limits of human behavior, policy, and economics. One of the most striking aspects of the current housing crisis is its uneven impact across the United States. Coastal cities like San Francisco, Los Angeles, and New York, long considered safe bets for housing appreciation, face sharp declines in affordability. Remote work, pandemic migration, and rising taxes have shifted the balance. People are leaving high-cost regions, putting downward pressure on prices, but the changes are uneven and unpredictable. In the Midwest, historically stable markets now face their own pressures. Cities like Chicago and Detroit, once considered affordable, are seeing stagnant demand even as builders hesitate to invest in upgrades or expansions. Population declines, aging demographics, and slower wage growth create a subtle, grinding pressure. Homes remain on the market for months. Sellers refuse to drop prices, hopping for the rare buyer who can afford a loan at current rates. Meanwhile, Sunbelt cities such as Phoenix, Austin, and Miami, which experienced explosive growth over the last decade, are entering a new phase. Prices are no longer climbing unchecked. Affordability is collapsing. Buyers who arrived seeking opportunity are now weighed down by debt that cannot adjust to rising costs. Renters, too, feel the strain as wages fail to keep pace with inflation. The very engines of growth that fueled the past boom are slowing. The lesson is clear. Location no longer guarantees stability. Regional nuances define outcomes, and in 2025, even the strongest markets are vulnerable. Investors bought into the housing market at its peak, lured by promises of predictable returns. Single-family homes became mini REITs. Neighborhoods turned into portfolios. Wall Street, seeing the success of platforms like Roofstock and Invitation Homes, doubled down. They bought thousands of properties, expecting rent to cover mortgage payments, taxes, and maintenance costs. But the math has shifted. Rising interest rates increase debt service costs. Maintenance, property taxes, and insurance have all climbed. Meanwhile, rent growth has slowed. Tenants, stretched thin, cannot absorb higher costs. Vacancy rates are rising quietly in some regions. Cash flows that once seemed guaranteed are now under strain. Unlike 2008, this is not a sudden collapse. It is a slow bleed. Investors are forced to either subsidize operations from other capital or liquidate properties at a loss. The effects ripple through local markets. When investors sell, they depress prices. When tenants default, landlords scramble to cover costs. The market is under pressure from both ends, and the tension is cumulative, not explosive. Perhaps the most human aspect of this crisis lies in the daily lives of homeowners and renters. Millions who bought during the low-interest era now find themselves trapped. Selling a home means giving up a 3% mortgage and taking on one at 6–7%. The very act of moving becomes financially punishing. This lock-in effect creates a paradox. Homes are available for sale, but sellers refuse to act. Buyers are outbid or priced out entirely. Inventory remains tight, maintaining high nominal prices even as real affordability collapses. Renters face a parallel struggle. Wages are stagnating. Costs for essentials, from groceries to gas, continue to climb. Rent, which should have absorbed some of the economic strain, is now a source of additional stress. Delinquencies are rising. Evictions are increasing. The delicate balance that kept households afloat is fraying, and with it, the broader market confidence. New construction, once the engine of market recovery, is stalling. Builders face a complex web of challenges: skyrocketing material costs, labor shortages, and higher financing costs. Every new project carries uncertainty. A home that cost $300,000 to build 3 years ago now costs $500,000. A loan that was feasible in 2020 is no longer sustainable. This slowdown in construction amplifies the crisis. With fewer homes entering the market, the illusion of scarcity maintains prices, even as actual demand falls. Builders are caught in a delicate balance between risk and reward. Too much construction risks oversupply. Too little maintains the pressure on buyers and renters, contributing to systemic instability. The result is a housing market that is frozen, overvalued, and underbuilt, a combination rarely seen outside periods of extreme economic stress. Government policy has historically served as a stabilizing force in housing markets. Mortgage interest deductions, down payment assistance programs, and regulatory adjustments were meant to create fairness and stability. But in 2025, policy is lagging behind reality. Attempts to stimulate demand, lower interest rates, tax incentives, or subsidies, conflict with the need to control inflation. The Federal Reserve walks a tightrope, balancing economic growth with price stability. Housing markets are caught in the middle. Local governments attempt interventions as well: rent control, zoning adjustments, and housing subsidies. These measures are piecemeal. Some help, some exacerbate the problem. Rent caps reduce landlord income. Zoning changes take years to implement. Subsidies only scratch the surface of structural imbalances. Policy is no longer a corrective force. It is a reactive one, struggling to keep pace with a market whose dynamics have changed fundamentally. Economics alone does not explain the market's current fragility. Human psychology plays a critical role. Fear drives behavior. When homeowners worry about affordability, they delay selling. When buyers fear overpaying, they hesitate. This collective hesitation magnifies market stagnation. Each actor waits for the right moment that may never come. This delay, multiplied across millions of participants, creates a paralyzing gridlock. Market psychology, often overlooked in textbooks, is a powerful force. In 2025, it is as influential as interest rates, construction costs, or regional growth patterns. To the untrained eye, housing may appear stable. Headlines report prices holding steady, but the deeper signals suggest instability. Months on market are rising across major metros. Cash sales dominate transactions, indicating buyer reluctance. Mortgage applications are falling sharply. Delinquencies and defaults are rising incrementally. Construction starts are declining despite high prices. These are subtle signs, not dramatic crashes. Yet collectively, they indicate a market under pressure, a market that is slowly losing its ability to function efficiently. Unlike a traditional crash which happens over months or weeks, the current U.S. housing crisis is a slow burn. It spreads gradually, unevenly, and quietly. Regions will diverge, investors will adjust, and households will adapt, but not without pain. This is a market breaking under the weight of its own complexity. Debt that was once cheap, wages that stagnate, rents that rise too slowly, and policies that react too late. Each factor alone would be manageable. Together, they create a fragile system, poised on the edge of larger disruption. The coming years will test the resilience of homeowners, investors, and policymakers alike. Housing is no longer a guaranteed pathway to wealth. It is a delicate balance between risk, timing, and affordability.